Hello, today is June 1st, 2020. I am Ashley Wilkins, Senior Wealth Manager with the Rice Partnership, and I'm with Orest Saikevych, our Chief Investment Officer. Hi, Orest, and happy June.
Hi, Ashley. Happy June to you and to everyone.
Today, I want to talk about what's going on in the markets. There's lots of talk about peak everything, peak earnings, peak growth, peak economy. Should investors be worried that we've reached a peak?
Well, I think we should pay attention to it, but on the other hand, I think there are a lot of offsetting situations here that call for us not to get too worked up over it. This has been a very difficult time for economic forecasting. Just taking a look at the last month, for instance, the April jobs payroll number was way off, much lower than was expected. On the other hand, about a week or so later, the consumer price index reports were way above what economists were looking for. That's due to a number of things: unemployment benefits, rental moratoria, supply chain issues, etc. We feel that the supply chain issues in particular are going to elongate and smooth out the overall trajectory, and also with global economies recovering at different rates, we think that will elongate the economic cycle overall. So instead of 6 to 8% for 2021, we may be looking at more like 6% real GDP growth this year, and instead of 3 to 4% next year, perhaps 4 to 5%.
Okay, great. What about inflation? Is this a short-term or a long-term issue, and what are we doing in clients' portfolios to mitigate the inflation risk?
Okay, overall, it's our feeling that this is temporary, that it is transitory. Now, we will have a bigger inflation number this year overall due to base effects, fact that we're coming off of such a low base. You're going to have kind of a rubber band effect. But as far as whether or not we're trending upward, the verdict is still out, and we really won't know for the next several months or maybe even a year out there. One of the things that will help mitigate any sort of a trend and keep it more temporary is the fact that we've had our supply response. If you'll recall, we had shortages of things like hand sanitizer, toilet paper, Clorox last year. Well, a lot of people bought those products, loaded up on inventory, plus you had a supply response. Manufacturers manufactured more. Now we don't have a shortage of those products anymore. Also, there is still a supply of labor out there that's looking for jobs, about 8 million people. Even though we have some fields, some industries that are looking for workers, can't find them, that's more of a supply or skills mismatch overall rather than anything else. Also, finally, the velocity of money, which is something we look at very closely. Velocity of money is still very low. It has not picked up. It needs to pick up for inflation to really start trending higher on a sustainable basis. As far as what we've done last several months, we bought reopening plays on their for the economy, like Disney, like Visa, like Hilton Worldwide Holdings, the hotel chain. We've also bought more of commodity type plays like a WestRock, which is a containerboard company, Freeport-McMoRan, a leading copper producer, and Deere, which is a play on the crop cycle for agriculture. So those are some of the ways we've kind of hedged our bets a little bit there.
Thank you, Orest. We appreciate your commentary as always and look forward to the next video. Have a good day.
Take care, everyone.